Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at ARM.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we really get going, I want to quickly mention that you can find the link to the VIP Algos down in the description below.
Yeah, you definitely want to check that out. It's an incredible tool for spotting these kinds of institutional setups.
Exactly. So let's just jump right into the wealth building context for today, because I want you to imagine a company that generated over $4 billion in revenue this past year, but they don't manufacture a single physical product.
Right, which is wild to think about. No factories, no assembly lines.
None of it. You could walk into their headquarters and you won't find, a single robotic arm stamping out silicon wafers.
Yeah, it's completely invisible, and I think it forces you to completely rethink how value is actually created in the tech industry today.
It really does.
Because, we are so conditioned to look for the physical widgets, right? The stuff coming off a conveyor belt. But in the global semiconductor space, the most valuable real estate isn't the factory floor anymore.
Right. It's the underlying logic, the invisible architecture.
Exactly. And that is what makes this specific business model so incredibly powerful. But also, it's notoriously difficult for everyday investors to value correctly.
Which is exactly why we are decoding their strategic positioning today. We really want to help you understand how ARM is successfully pivoting from being this sort of quiet background player inside your mobile phone to becoming the undisputed main character in modern AI data centers.
It's a massive shift.
It is. We're going to break down their fundamentals, parse through the technicals, look at the catalysts, and unpack the sentiment. And most importantly, we need to figure out if the stock's recent, frankly violent price swings represent a massive red flag or a hidden wealth-building opportunity.
Yeah, and to even begin diagnosing those wild price swings, we really have to isolate what they actually do. Yeah. Because their moat, their competitive advantage, is entirely unique.
Yeah, they operate what analysts call an extremely capital-efficient, asset-light model.
Right.
But let's ground that jargon for a second, because asset-light gets thrown around constantly. We are talking about a company that brought in nearly $5 billion, but they do not fabricate chips. So if they aren't making the physical hardware, what are they selling that tech giants are just so desperate to buy?
Well, they're selling the instruction set architecture, the ISA.
Okay, unpack that.
So if you think about a computer, you have the physical hardware, right?
Yeah.
The actual silicon chips and transistors. Mm-hmm. And then you have the software, the code that tells the computer what to do.
Right, the brains in the body.
Exactly.
Yeah.
But those two things don't inherently speak the same language.
Yeah.
The ISA is the fundamental vocabulary. It's the translation layer that allows the software to actually communicate with the hardware.
Oh, I see.
So ARM designs this incredibly complex architecture. They patent it, and that intellectual property is their product.
So if I'm picturing this correctly, it's almost like a master architect who draws up the most brilliant, structurally sound blueprints for a massive skyscraper.
That's a great way to look at it.
But this architect never actually buys a single steel beam. They never pour the concrete. They never have to, hire a construction crew or deal with massive supply chain headaches.
No, none of that overhead.
They just hand over the blueprint to a developer. But the catch is the architect gets to collect a toll on every single office that gets built and every single person who walks through the lobby forever.
Yes, that captures the operating leverage perfectly. Massive tech giants like Apple, NVIDIA, Samsung, Qualcomm, they're the ones taking on the immense financial risk of pouring the concrete.
Because building a chip fabrication plant costs, what, tens of billions of dollars?
Exactly. It's astronomically expensive. So those manufacturers take ARM's blueprints, they build the physical chips, but they have to pay an upfront license fee just to look at the design.
Just to look at it. Wow.
Yeah, and then a recurring per-chip royalty for every single unit they ship out the door.
Which means they completely avoid the massive costs of manufacturing. They just take that huge stream of free cash flow and funnel it right back into R&D to design the next better blueprint.
Precisely. It's a compounding machine.
But here is where I get stuck, and I'm sure some listeners are wondering this too. If they don't even make the chips, why do hyperscalers like the massive cloud providers, Amazon, Google, why do they rely on them so heavily?
That's a fair question.
I mean, if you are a trillion-dollar behemoth like Amazon, Why not just draw your own blueprints and avoid paying the toll entirely?
Well, it really comes down to the immense switching costs and what we call ecosystem lock-in.
Lock-in.
Right. Building a new instruction set architecture from scratch isn't just about drawing a new blueprint. It's about forcing the entire world to learn a completely new language.
Ah, because the software is already written for ARM.
Exactly. Over the last decade, an entire global ecosystem of software developers has written billions of lines of code specifically designed to speak the ARM vocabulary.
Right.
If Amazon suddenly switches their server hardware to a completely different proprietary language, none of that existing software will run natively. It would literally break the ecosystem.
So you'd essentially be handing a Japanese dictionary to a workforce that has only ever spoken English and expecting them to write a novel by tomorrow.
That is the reality of the engineering bottleneck.
Wow.
And because of that lock-in, ARM-based processors currently account for about 50% of CPU deployments among major hyperscale cloud providers.
Wait, 50%? Half the cloud infrastructure speaks their language.
Yes, half. It creates this massive structural revenue tailwind that guarantees their income. Honestly, it doesn't even matter whether NVIDIA or AMD or Intel wins the specific hardware market share battle. As long as the chips speak ARM, they get paid.
So if you own the vocabulary, you get a cut of every single conversation.
Exactly.
And right now, the loudest conversation on Earth is obviously artificial intelligence. Which brings us to their fundamentals. The traffic patterns through that toll booth are changing aggressively.
Yeah, massively.
We are seeing this huge pivot toward AI data centers. And if you look at their fiscal 2026 results from May, it shows undeniable acceleration. Total revenue was up 23% to nearly $5 billion. Net income hit $904 million.
Yeah, but the headline numbers don't even tell the whole story here.
No, what's the real story?
The real story is hidden in the revenue mix. While their upfront license revenue jumped a very healthy 29%, their data center royalty revenue more than doubled year over year.
Doubled. That is insane.
It is a staggering acceleration in high-margin cash flow.
And you have their CEO stating clearly that demand for their AGI CPU, their artificial general intelligence processor, is just blowing past expectations. They've built a confirmed pipeline of over $2 billion in customer demand stretching through fiscal 2028.
Yeah, the visibility on their earnings is incredible.
But I want to push back on this on behalf of anyone listening who really follows the tech sector closely.
Sure, let's hear it.
When you hear the phrase AI revolution, the very first thing that comes to mind is GPUs, graphics processing units. I mean, NVIDIA is absorbing almost all the oxygen in the AI room right now.
True.
Because their GPUs are the engines powering these massive models. So why is ARM's internal CPU revenue suddenly forecasted by analysts to scale to $14 billion by 2030? Like, why is the CPU suddenly stepping back into the spotlight?
Right. That discrepancy really gets to the heart of how artificial intelligence is actually evolving right now.
Yeah.
We are currently transitioning from the training phase of AI into the agentic phase.
Okay, break that down for me.
So when you are training a massive large language model, literally feeding it the entire internet so it learns how to speak, you need the brute force, parallel processing capabilities of a GPU.
Right.
GPUs are designed to do millions of complex mathematical calculations at the exact same time.
It's just brute force, throwing raw computational horsepower at the problem.
Exactly. But that brute force comes with a massive physical cost. GPUs run incredibly hot, and they consume a staggering amount of electricity.
Okay, so where do CPUs come in?
Well, think about the next phase, which is agentic AI. This is where you deploy millions of AI agents out into the world to handle everyday background tasks.
Like an AI that monitors your email, cross-references your calendar, books a flight?
Yes, that requires complex sequential logic running constantly in the background 24 hours a day. You can't use a massive power-hungry GPU for that.
Right. The power grids literally couldn't handle millions of GPUs running 24/7 just for mundane background tasks.
The data centers would literally melt, or they just run out of electricity entirely.
So the heat and power bottleneck is the exact reason the industry is pivoting back to CPUs for these specific tasks.
Yes. Hyperscalers are desperately looking for a way to reduce their capital expenditures and power consumption. And remember, ARM spent the last 15 years completely dominating the mobile phone market, where battery life and thermal efficiency are literally the only things that matter.
Ah, of course.
They are the undisputed masters of low-latency, power-efficient computing.
So the tech giants are essentially taking the hyper-efficient, power-saving architecture from our smartphones and scaling it up to run the massive AI data centers of the future.
Exactly. And the institutional validation for this shift is already here. I mean, Meta recently entered a multi-year strategic partnership to co-develop their AGI CPU roadmap directly with them.
Wow. When a titan like Meta anchors their future hardware roadmap to your architecture, you aren't just participating in the AI wave, you are the bedrock it's being built upon.
That's right.
Okay, so the fundamentals are screaming growth. The ecosystem is locked in. The AI pivot is a real structural shift. You hear a multi-billion-dollar pipeline, and you assume the stock chart is just a perfectly smooth rocket ship.
Right, you'd think so.
But let's talk about the technicals and sentiment, because last week that rocket ship seemingly fell out of the sky. The stock is up over 111% over the past year, but it just suffered a sharp 19% pullback in a single week,
Yeah, that was brutal.
including a terrifying single-session drop of over 10%.
A 10% drop in one day evaporates billions of dollars in market capitalization. That is severe jarring volatility.
It gapped down hard. The analysis attributes this to a broader market rotation out of AI names, combined with investors getting spooked by some macroeconomic news regarding tariff pauses.
Yeah, there were a few macro headwinds converging.
But here is my question for you. Are you saying a 19% drop is just a healthy reset? Because
But-
to a normal investor listening right now, watching a fifth of your investment vanish in 5 days is terrifying.
Oh, absolutely. It makes people want to hit the sell button immediately.
Yet while algorithmic sentiment tracking dropped to a neutral zero, Wall Street analysts aggressively defended the stock. TD Cowen hiked their price target to $475. UBS raised theirs to $470.
Right.
Are the institutions just seeing a completely different reality than the everyday retail trader?
Well, they are operating on a completely different time horizon, which completely changes how they interpret that volatility. What you are describing is the psychology of a classic market shakeout.
A shakeout.
Yeah. When a stock runs up 111% in a year, it attracts a massive crowd of short-term speculators. People who, they don't actually understand the instruction set architecture. They just see a chart going up and want to momentum trade it.
Right. They are renting the stock. They aren't owning the company.
Exactly, the distinction. And those short-term traders have very weak conviction. So the moment a macroeconomic headline hits, like a vague fear about international tariffs or the broader tech sector takes a breather, the speculators panic.
And they all rush for the exits at the exact same time.
Which creates that violent 10% drop. The momentum resets. It essentially clears the deck of the weak hands.
But while retail is panicking and selling, the institutions are on the other side of that trade, buying.
Because institutions are modeling out discounted cash flows all the way to the year 2030. They are looking at that locked-in $2 billion demand pipeline. They use the liquidity created by the retail panic to build larger positions at a massive discount.
Which makes sense.
If you want a glimpse into that level of institutional conviction, just look at Masayoshi Son, the CEO of SoftBank. SoftBank is the majority shareholder, right? He recently went on record stating his belief that the company could eventually be worth $4 trillion.
$4 trillion. I mean, that is a heavy, almost unfathomable statement.
It really is.
But, sky-high price targets and visionary CEO quotes are one thing. A stock needs actual real-world events to push the price higher. It needs near-term catalysts. Because if institutions are using this shakeout to quietly build their positions, they're waiting for a specific domino to fall. They need proof that the AI narrative is real today, not just in 2028.
And we're going to get a major piece of that puzzle very soon on July 29th.
Right, the July 29th Q1 fiscal 2027 earnings report.
The entire market is going to be hyper-focused on one specific metric during that call, and that's the forward guidance for royalty revenue.
Because the market needs confirmation that the AI data center adoption is actually flowing through the income statement right now.
Exactly. And the ecosystem is visibly expanding ahead of that date. Oracle Cloud Infrastructure just announced they are joining the ecosystem. AWS, Microsoft, SK Hynix. They're all aggressively expanding their support.
But there is a fascinating, unconfirmed rumor circulating right now that I want to dissect. Qualcomm is reportedly forecasting $15 billion in data center chip sales by 2029.
Yeah, that's a massive number.
But how does another company's massive sales forecast act as a direct catalyst for ARM?
Well, it highlights the sheer beauty of their operating leverage. Think about a traditional company. If they want to generate $15 billion in new sales, They have to spend billions on new factories, raw materials, labor, all of that.
Right.
But they own the intellectual property toll road. If Qualcomm successfully ships $15 billion worth of server chips, that represents a disproportionate, massive step up in the royalty revenue base.
And they didn't have to lift a finger or hire a single new factory worker to build those chips. They just collect a larger toll because the highway got wider and busier.
Exactly. And the profit margins on that incremental royalty revenue are astronomically high. Every time a partner succeeds and scales, they get a raise without taking on any of the manufacturing risk.
Okay, so we have spent a lot of time building up this flawless machine, a high-margin, asset-light monopoly with locked-in customers. But let's look at the risks.
Yeah, the bear case is important.
Because every structure has stress points. You have to inspect the foundation to avoid a collapse. And there's a very real bear case here that we need to unpack. First and foremost is regulatory antitrust scrutiny.
Right.
U.S. regulators are currently examining whether their licensing practices give them anti-competitive leverage. And South Korean regulators have actually physically inspected their Seoul office.
Yeah, when you control 50% of the global cloud infrastructure, governments start paying very close attention to how you price your tolls. It is an unavoidable headwind for a company with this much market share.
I want to take this a step further and debate this because this feels like the absolute elephant in the room.
Go for it.
If global regulators step in and actually cap the royalty rates they are allowed to charge, like if they look at them and say, you control the foundational language of the modern internet, you are no longer just a tech company, you are a public utility, and we are capping your prices.
That's the nightmare scenario for investors.
Doesn't that completely break the asset-light hyper-growth model we've been praising this whole time?
It's a critical vulnerability, absolutely. If they cannot expand their royalty rates as the technology gets more complex, the terminal value of the company takes a massive hit.
Terminal value, meaning the long-term math Wall Street uses to justify the stock price today?
Exactly. If you cap the tolls, the long-term math breaks down and the stock valuation has to compress.
Add to that the fact that their valuation multiple is currently one of the most stretched in the entire semiconductor sector.
Oh, it was very high.
The market is pricing in absolute perfection, and their internal chip business won't even be financially material until fiscal 2028. So if regulators stall them out, is this whole thing just a house of cards?
Well, the multiple is undeniably high, and the regulatory threat is very real. However, the market structure provides a fascinating mitigation for this risk. It's essentially a mutually assured destruction scenario within the tech ecosystem.
Mutually assured destruction. How so?
Their architecture is so deeply embedded in the global compute infrastructure that if regulators tried to ban their practices or severely restrict their operations, the collateral damage would be catastrophic.
It would bring everything down.
Exactly.
Yeah.
It would immediately trigger massive pushback from the biggest tech giants in the world. Apple, Amazon, Microsoft, Meta, they all rely on this architecture to function and innovate.
Right.
They cannot afford for the R&D to slow down, so those trillion-dollar companies will lobby heavily alongside them to ensure the architecture continues to advance. You really can't break them without breaking the global tech economy.
So their greatest defense against government regulation is the fact that the biggest companies in the world are entirely dependent on them. They are essentially too foundational to fail.
That's the argument.
Yeah.
Regarding that valuation risk, the high multiple and the timeline gap between now and 2028, that is exactly where that $2 billion pipeline becomes the ultimate safety net.
Because it gives them incredible visibility.
Right. It isn't just a hopeful projection. It is contracted, secured demand. That pipeline fundamentally de-risks the waiting period.
They have the receipts in hand before the products even ship.
Exactly.
Okay, so bringing all this together, what's the final verdict on the setup here?
Well, our analysis delivers a 9 out of 10 bullish score.
9 out of 10.
Yes. We are watching a company successfully execute one of the most difficult strategic maneuvers in the technology sector. They are transforming from a pure intellectual property licensor for mobile phones into the premier data center CPU designer armed with a multi-billion-dollar AI pipeline.
And despite the jarring sector-wide pullback we saw last week, the aggressive price target hikes from major institutions suggest that the 19% dip actually presents a high probability setup for long-term capital appreciation.
Absolutely. The weak hands have been shaken out, clearing the path as we head into that crucial July 29th earnings catalyst, which is really poised to validate this massive royalty ramp.
It's incredible. We started today talking about the physical world versus the invisible. the tangible factory floor versus the abstract architectural blueprint. They have built an empire by refusing to pour the concrete and instead choosing to own the mathematical language that the modern world relies on.
Yeah, they've built the ultimate unavoidable toll booth for the artificial intelligence era.
And as the shift from power-hungry GPUs to hyper-efficient CPUs accelerates, that toll booth is only going to get busier.
Definitely.
Which leaves us with a final thought for you to ponder on your own after we wrap up today. We discussed the idea of them becoming a public utility.
Yeah,
But think about the paradox of that success.
right.
If their architecture continues to become the absolute, undisputed standard for all future AI computing, making them the indispensable bottleneck for global technological progress, at what exact point does their greatest competitive advantage, that undeniable ecosystem lock-in, become the very thing that forces governments to step in and regulate them?
It's a fascinating paradox. Can a company be too successful for its own good?
We'll let you think on that. And just a reminder, if you enjoyed this, please subscribe, like, and comment underneath. And don't forget to check out the VIP Algos link down in the description to spot more setups like this one. Thanks for joining us, and we'll see you next time.